Good afternoon, everybody, or good morning, I guess the case may be. This is Jeff Scott. This is my weekend review for the 27th of 2016. I've called today time to refresh, and I'll make the case as we go through why I wouldn't be surprised to see the market slow down and take a breath. I'm not saying roll over and crash. I'm saying take a breath, maybe allow some sector rotation to come in into what is typically a very strong seasonal time of the year. Disclaimer, this is for education purposes only. Any recommendation of this Bureau of Education, not investment advice. I'm a doctor, not a broker. I am independent. As you read here, I paid for all this software, and I don't work for, get paid for, or have partnerships with any existing trading vendors. And trading involves risk. You and you alone are solely responsible for any investment decisions you make. Be your own guru. I've married the best of canceling with the teachings of John Person, as I describe on many of my prior videos. Cancelim's a great foundation. John is like the difference between a Cadillac and a Mercedes, in that John, it gets you there, maybe gets there a little quicker, a little bit nicer, but John has some moves that you won't see in Cancelim that I find to be very, some setups and some signals that I find very useful, especially when taking trades, not just thinking about what to buy. George Lee is my trading buddy for the Pacific Northwest, and Van Tharp, the god of position size and money management. I own a lot of programs. I don't need a lot of programs. If hard drives shrunk up and I had to go down to just a couple, it'd be TradeStation, Thinkorswim, HGSI, and EdgeRater. The other is Genesis, is a high-end charting platform that's probably beyond the needs of most people that listen to me. Seasonality and websites are a number that I use, and now both Best Choice and Magenta are web-based, while Seasonality Trader is Java-based. The website for highgrowthstock.com is here. Just to be clear, I am unaffiliated with this product, except I'm a user, and I've been providing amateur, non-paid, non-professional support to users for a decade. If you go under investing strategies, you'll see a number of names. If you look at Ron Brown, you'll get some great philosophy on trading as well as how to use the program. Under my name, you'll see a lot of my past weekend reviews. Up here, you can order it for free. It's the only place I know that's silly enough not to even ask for a credit card. Stock patterns are cyclical. Boy, who would have known that you wake up right down here on the morning after the election, and all of this occurred while you were sleeping. And if you were able to get into the market early, especially overnight, you had a chance to recoup and make a lot of money. In fact, if you were a perfect market timer, you would have been in cash all year until Wednesday morning and just bought everything in sight Wednesday, and you'd be having a great year. Because of my overtly bullish time over the last couple of weeks, I've been very aggressive buying stocks, calls, puts, selling puts, covered calls. I don't do in this market. Well, I don't want to be stopped out, but I will do bull put spreads, and both bull put and bull call spreads. A bull put spread is I'm selling a put, and then I'm buying a put underneath to protect my margin dollars. If I think the market's going up, the put that I sell, since it's closer to the money, is more expensive, and therefore it will go down in value. I'll make money because I sold it. Or I could buy a call spread where I'll be buying a call at the money or near the money and selling one out of the money to reduce my investment. If I look at where the market closed Friday, energy was the sole source of weakness, with oil down about $2. Broker-dealers were a little bit weak. I'm not sure what the news was there. Banks were mixed. Banks are one of those entities that you wonder when they're going to take a breather. If we look at the major markets, if you listen to me for any length of time, I've been calling for a melt-up, and we got our melt-up. You look at especially the YM, the Dow. This is the election night where the market, or this is the day after the election, because I think it starts at 4 o'clock. The market traded down 600-700 points and closed up on the day. Who would have thought that? And it just has taken off since. And you could see the same thing for the rest of the indexes. I don't think the S&P closed up that day. But take a look here at the E-minis, the NQs, which are lagging, opportunity for rotation perhaps. The YMs and the Russells leading. The VIX is down, and the dollar traded off a little bit this week, but the dollar's been on a tear as well. Major markets, looking on the weekly charts, you could just see the long run that we've been in. Again, the underperformance of the NQs, where everybody else seems to have broken their, again, ES, NQs, YMs, and TFs. Everything else has taken out their prior highs, not yet on the NQs. And then I take in Genesis, and this is running in the background in other time frames all day long, but the top time frame is daily, then weekly, and then monthly. The first column is E-minis, the second column is Russell futures, the third is NASDAQ futures, the fourth is NYSE, and the fifth is the Dow futures. And again, I don't care what time frame you look in, you're in buy signals everywhere except the laggard. The NASDAQ 100 did get a buy signal 2 weeks ago on the weekly, still in a sell signal on the monthly. Everything else is in a buy signal on this sheet. One of the big drivers of banks has been rates, and you can look at both the 10-year and the 30-year coming straight off the bottom. These lines here are between 2.5 and 3, and I put those on years ago because to me that was always the sweet spot in that rate. When rates are like that, I think the markets can behave nicely. When the rates were below it, it actually, although it stimulates the market, it sort of tells you that you have a bad economy, and that's why rates have to be low. And when the rates get above 3, I think the market's in trouble, and we'll see how long before we get there. For all these slides, the thing that's identified here is the white, and the S&P for comparison is yellow. Here's the 10-year, same picture. AD lines, both the small stocks and the large stocks, are at new highs, so no breath issues there. Now, from an overbought perspective, this descending trend line here is where we've peaked out in prior rallies going back to 2000 and I think that's 9, actually, 10, 11, 12, 13. Yep, since 2009. Now, we are actually at that level here. It'll be interesting to see if we break above this or not. And typically when we've peaked, you've seen a little bit of a delay, and not necessarily a rollover, but the market seems to pull back some. On the 40-day, getting also close to that point. Now, where I'm really believing that we got a pause to refresh coming, here's the 13-week new high, new low. And I drew this line, again, if you watched me before, you know I don't change any of this analysis. I just look at it every time. And when I hit this line, the market reverses. When I hit this line, the market reverses. It can reverse before, but this is the extremes. And we are at that extreme now where one would expect a reversal. Now, all this reversal is in a new high, new lows. If stocks go sideways and pull back 1 or 2%, while the rest of the market, which is underachieving, increases, then you could have this go sideways or stay up and the market pull back a little. And that's kind of what I expect to happen. The McClellan, to me, it's useful at extremes. I've plotted here, this is at the NYSE on the daily. The NYSE getting close to break out to a new high. There is a divergence here where we haven't broken zero on the summation and we're not out to new highs on the oscillator. If I look at the weekly, similar story, the NYSE not out at new high. We are below zero on the summation index, and not sure there's much divergence on that one. Buckets are a HGSI concept and edge rater automation that give me a sense of how oversold or overbought the market is. What I know is that if I take the S&P 1500, and this is created on the 13th, so it's up to date on which stocks are there, and I look at how many stocks are above or below the midline of the Bollinger Bands. At the low in this market on the second, 77% of the stocks were below the bands. 77% were below the midline on the S&P. 1,500 stocks were below the midline of the Bollinger Bands, and over 20% were below the lower band. So one knew that this market was going to rebound. 12 days later, about 8 trading days, we had 76 above and nearly 40% above the upper band. Again, we knew the market would probably pull back a little bit. On the 18th, several days later, you could see that has happened. And now if we look at on the 25th, you could see we continue to be bought with the number of stocks above the midline of the Bollinger Bands and the S&P 1500 being 88%, but we're not to an extreme over here. So this could argue we have more room to go. The Hindi is a sign that has predicted. It's occurred prior to every major pullback in the last 50 years, including what we saw in 07, 08. And there is no Hindi here. It would light up red over here. This is automation on the NYSE and just as a test on the Russell 3000. The Woody indicator is this third set of columns, and you could see we've been in green now, and we've had a nice bull run, and this followed a series of kahunas that occurred back here on, well, it's got to be the day after the election. What's interesting here is you make money when it's green, if you're long. You make money short when it's red, and when it's going back and forth and chop, it's tough to make money at all. This is one of those good periods of time. You'd have to go back to July to see a similar run. It is not yet overly long in the tooth, but it's getting closer. And then if you look at sectors with the Woody indicator, it's where my arrow is. The one that's lagging now is staples. Utilities actually just turned positive. Now, I mentioned several times that the NASDAQ has been lagging, especially the NASDAQ 100, not necessarily as much the composite. And in the NASDAQ 100 are the generals, and typically these are the leaders. And this is an index of some of those generals that we follow. And after a steep pullback and a nice recovery, they're still below the 50-day moving average. So these generals are lagging, and perhaps what will take us higher the next leg could be some market rotation into the generals. You need to know your earnings and news dates. This is a busy week. We get some GDP, we get some consumer confidence, we get some Chicago PMI, we get some energy, we get some unemployment numbers. Unemployment, as John Person calls, and the big monthly unemployment in December. This is the month that we also expect to see a rate increase. I think everybody is expecting a quarter point. I just throw this out for a teaser. If you look at where rates have gotten on their own, why doesn't the Fed do a 50 basis points rate? I think that will surprise the market. So let's hope it's only 25 basis points, but 50 basis points might make some people think there's more strength to the underlying market than there is, but I haven't heard anybody talk about it, so I'm not starting rumors. Light week for earnings, not light if you have these stocks, and you need to know where your earnings are. And as I said here, it's a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. This comes from levittbrothers.com, and this is free on their website. Market thoughts. The major markets continue their melt up. The general's lagging, dollar higher, VIX dropping. The markets, and then it said overbought markets typically get more overbought, but several of my indicators suggest a pause to refresh might be in the offering. At least some rotation to laggard groups while leaders catch their breath. But always trade the market we have and get, not the one you think we should get. And right now we have a market that's pretty bullish. Typical report, and again, I've suspended the chart of the day until next year because I don't always know that I'm going to be doing this on a weekly basis. I just realized I forgot to import my list. So let me just do that really quickly. And then we'll go look at TradeStation while this is coming in. Import user group. And my user group is going to be in here in my Dropbox. I just love Dropbox. I share all these files between my many different computers. Perfect. All right. So in TradeStation, I always like to look at the health of the market and the individual industry groups or sectors. Now, I look at 4 or 5 different things. One of the things I look for is the last arrow. A green arrow is a buy signal. A red arrow is a sell signal. I look at daily, weekly, and monthly. Another thing that I like to look at is the color of the paint bar. If the paint bar is green, that's bullish. If it's red, that's bearish. And if it's blue, it's neutral. The third thing I'm going to look for is going to be evidence of MACD divergence or convergence. I'm going to look for little red or green dots. The fourth thing I'm going to look for is where is my relationship to the auto envelope. And the fifth thing is what is my high jump bar. And I know that when my high jump bar gets above 95%, it's also time for a pullback or at least a sideways move. So here's the E-minis. We see a green arrow on daily, weekly, and monthly. Blue on the daily, not surprisingly, as it gets more and more extended. Green on the weekly and monthly. High jump's not dangerous. There's no dots. I'm bullish on the E-minis. On the NASDAQs, it's still green, which is good, and it's a arrow. It's at 82%. There's no dots here. It's in a new weekly buy and a monthly buy. So this might be the place to chase because this one may have more room to run. The YMs, now you can see up here, these are those red dots that tell me it's getting extended. There's some MACD divergence. And look, the YMs are at 100% on the high jump bar. That means is the way I measure extension, which is the distance the price is from the 17-day moving average plus the distance from the 50 plus the distance from the 200, adds up to the largest amount in 200 days. This is the most extended that the Dow has been in 200 days. I find that to be a little bit worrisome. A blue bar there, green daily and weekly and monthly. So still very strong, but I'm a little bit nervous. It's outside the envelope, and more importantly, the high jump bar at 100 is pretty reliable. So a little worried about the Dow rather. And then the Russell's the same way. In a buy everywhere you look. MACD divergence on the weekly, pegging at 100%. Now notice it's been at 100% for several weeks, so days. It may continue to go higher, but we're probably closer to the end of this run than the beginning. But based upon seasonality, I expect a sideways or something to ease the pressure, and then the market perhaps just to keep on running. If we look at the dollar, at 93%, everybody else is a buy, but a blue on the paint bar. And if I look at gold, notice the green dots. Gold is starting to show some divergence, or positive divergence, or convergence, as John calls it. High jump bar is at 0. So gold might be at a place where it's ready to bounce. Certainly in a sell signal, I like to see it move, not just because it's at a place it might bounce. I'd rather see it bounce before I jump and chase. And oil fell hard last week. On Friday, you can see a new sell signal in a red bar here. This break here is because of Thanksgiving. So then I quickly look at the industry groups. Healthcare. I'm just going to look at it very quickly. Healthcare has some weakness. It's in a sell signal in all 3 time frames. Thought this was a strong market. 48% on the high jump. Financials. Looks like the Dow and the Russell. Don't know what happened here, but for whatever reason, let me just go to FAS. I think there must have been a change in the symbol because TradeStation only gives a few days. You can see financials have had a big run at 98% with MACD divergence. Financials look like they need a rest. Discretionary, 99, look like they need a rest. Big run. Technology. Looks like it has some room to run with a new weekly buy signal coming in. Actually looks as good as anything I've shown you, only at 76%. So again, the NASDAQ 100 leaders. Industrials, 100%. Looks like they need a rest. Staples. Also, as I said, it had a new, the Woody indicator had a new sell signal, but it's got MACD convergence, positive divergence. On the daily, it's got a new buy signal this week. It's still in a weekly and a monthly sell, looking for stables perhaps to show some improvement. Materials have been strong, and you can see even on the daily and on the weekly there's divergence, green arrow, so continues good, up, but extended. Utilities turned around last week. The MACD divergence on the daily, now up bar with a green, but still in longer term weekly and monthly sell signals. And energy has been doing well, although it did sell off on Friday. So you look at this, and healthcare is probably the worst looking of the bunch. And a lot of them, industrials included, financials, look like they're getting toppy, or not toppy, but getting extended. So again, I am not by any means calling for a massive sell-off. And overbought markets, especially in the setting of a melt-up, will get more and more overbought. I am looking to see if technology and maybe, this is discretion is already up there, the NASDAQ generals might be able to pick it up and drive this market higher, allowing some of the things that have been leading some time to refresh. Just a thought of what I think would actually be very good for the market if we saw that happening. All right. So let's now take a look at the major markets. See, we can't make sense of the market here. Let me just size things up right. Major markets plus, and I want the T1 view, which looks at price and volume, weights today, Friday, then last week, and then 3 weeks, but most of the weighting is on Friday. And we can see that the leader here is NYSE, small caps, the Dow, the NASDAQ are up at the top, gold, volatility, bonds, oil, silver, gold, dollar on the bottom. No wonder it was a strong week for markets. The things that we buy typically were up, and the things that are the opposite or sort of contrary to what we buy, like bonds, perhaps the dollar, volatility, were to the downside. Let's take a look at some of these. We'll start with the S&P 500. There were no kahunas last week, but this is a clean view. Let me just review this with everybody. On the top is my buy-sell signal on the weekly, the bongo. I was part of a group that put this together. It's green. This is the daily bongo. I look at the weekly bongo to give me a sense of, are we trending up or trending down? The daily bongo in the setting of a long-term weekly bongo green are when we get pullbacks in the market and potentially times to jump on board. The next is looking for Hindenburgs. As I already told you, there were none. The last Hindenburg signal we got was back here in June, and it's not typically one that will get my attention. If I go back, for example, to 2007, it was the series of Hindenburgs here that should have gotten you out of the market, and you could see what the market did after that series of Hindenburgs. It's not a single Hindenburg, it's a series of them. So one spurious Hindi just gets you aware. So here's the S&P 500. I had thought that we were in a bit of a wedge, and we broke down, pulled back amazingly to support, at least on the cash markets. We pulled much below that after hours and bounced at that to new highs. It's interesting how these moving averages become magnets. That's the S&P. Dow Jones Industrial looks the same, didn't quite pull down to the 200. If I look at the NASDAQ, again, similar pattern, broke down, didn't quite get to the 200, now broken out to new highs. And then lastly, the Russell 2000. And it's clearly melting up. So I look at these, and also these are kahunas and a Eureka, which is a market follow-through day, reversal day, and you could see that all of this occurred on the 7th. I think the election was on the 6th. So just like in England, where they told us that if Brexit lost, the markets would collapse, we were told by the same liberal press, I don't want to be political, but we know they're not pro-Trump, that if the markets, if Hillary lost, the markets would sell off. In both cases, the elections were a surprise, and in both cases, they did not sell off. If I look at the dollar index, you know, dollar's getting high. It's taken out a multi-year high. The dashed button goes back to, this is the 2015 high. And it takes a long time before you see those dashes again. Come back here. So we are at a multi-year high on the dollar. That's bad for metals. It could be bad for people that sell products overseas. And look at the number of kahunas that got this dollar moving. You know, if the dollar's high, you kind of know what gold and silver look like, and they just don't look any better than they have. Continue in free fall, and silver, which may have some more industrial uses, also down. And what about miners? Do they look any better? No, they got to sell their gold. And lastly, the VIX. You know, this is kind of where the VIX ends. Now, if I was bearish, I would say it likes to move up from this level. It does. Most rises in the VIX occur from this level or higher. But if I was honest with you, which I try to be, it can be like this for a month and a half. So VIX is low when the VIX is low. Look out below when the VIX is high. It's time to buy. It's these spike ups like we had here, 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 and here, is which it precedes a bull run. When we're low, it's when it starts to move up that your stocks will fall. Let's see when it starts to move up. Next thing I like to do is go down an industry group rotation, and we have 174 groups, and let's look at those with my 2-day force that are actually moving up right now. Give you a sense of where the money is flowing into this market. And it's sort of the same old, same old. So what I do on my own, let me just show you, if I left click on steel. Now, what I do when I do my own evaluations, and I'm not going to do it here because I don't think the charts are big enough for you to see, but you can take and open up a second chart, file, new charting window, and I've become increasingly impressed with the value of weekly charts. So I usually open up a daily and a weekly chart. And I do that because the weekly chart certainly gives me a sense of the longer term trend, and I don't want to buy something that's moving up and about to hit major resistance on the weekly chart. So I think it's very useful, and with HGSI you can open up multiple charts. But let's stick with the daily charts as we typically do, and let's go into my webinar view. So here's a quick review of what you're seeing here. Since I know there's no Hindenburgs, I closed them on top. This here is the weekly and then the daily bongo. This is accumulation distribution. This is a 13-day and then a 2-day force. This is the high jump bar. When it's up at the top, I know we're extended. A red candle high usually occurs as a reversal signal, signifying a potential down move. A green candle low is also a reversal signaling an up move. Then we have Bible gap ups, squeezes, mobile breakouts and breakdowns. Down here are pocket pivots, on-balance volume, and then regular volume bars with my kahunas. Blue is good, red is bad. And these are the Eurekas, which is on the market, not on my stock, follow-through days or exuberant buying days. This is bullish, red is bearish. So let's go back up here and do a right-click, change to index group. And these are some of the stronger stocks in the market. These are steel suppliers. Now, in the window part, we have the gray is the industry group. So we can see how strong this industry group has been. Obviously, candlesticks. This is an 8-day exponential. And then 3 simples, 1750 and 200. OBV, volume, I already talked about these. So this is Cliffs Natural Resources. This was once a high flyer, and you could see it got up to 120 when iron ore was hot and China was hoarding before the market rolled over. We're nowhere close to that. We've had a beautiful run off of 1.5. And if you look at since the beginning of the year, we're up 527% on Cliffs Natural Resources. Of course, if you wrote it down from 100, yes, you can pat yourself on the back for 2016, but you're still down 90% from the high. What can I say? It's clearly extended, sort of a cup and a handle and a breakout. I don't get in the way of these major bull runs, so I think this has a power to go higher. But again, it's a tough place to be buying new. Vale has the benefit of both ore and Brazil, and you can see it's had a nice run, and it's up 156% from the beginning of the year. Neither of these are necessarily at a buy point, but you know, may be something that is okay. Now, I don't know where TCK is. I think it's in base metals, but this is one that I called earlier in the year, and this is a beautiful chart as well. And you got to look for periods of time like this when it pulls into the 50 to find times to buy. And this is a stock that's up 565% this year. Look at the earnings per share growth coming into the stock. So I don't for a minute believe that 107 is the right multiple, but let's say you get that 235, and let's say you get, just add 20 cents more, so you're at 255, you're trading at a multiple of 10. Do I think that's the right multiple either? No. So if this came down to 30, this could be a $60 or $70 stock in the next year or two. So I'm still long Techminco. It's one of my big wins of the year. So steel raw materials look good. What about steel producers? You know, sometimes you're afraid to buy things too late, and then the other thing, and then you just get lucky. So I've been in U.S. Steel for a while this year, kind of just for the same reason that I bought Techminco. And, you know, you look at it over a long-term basis on a weekly chart, who'd want to touch this? But it was down here where it was interesting. The market's turning around in February, March with the Eurekas. We went to a long-term buy signal on U.S. Steel in late January. You had a kahuna come in here. So there were a lot of reasons to get into this stock somewhere in the $8 to $10 range. And I think that's about the time that I did get in. It's had a great run. You could have gotten into the stock here. You could have gotten into the stock here. You could have gotten into the stock here. Each of these times look like great opportunities to get into U.S. Steel. It's a stodgy old name, but it too has great earnings per share growth coming in. 28 and 5, 33 cents, and 40, 73 cents, minus 30, 40 cents. You'll be sitting, so that's not great. But if the trend continues and you start to drop off this minus $2.15 earnings, you may get to a point where U.S. Steel looks like a growth stock with that type of a growth rate. Would I buy it now? No, it's too extended. I look for pullbacks. AK Steel, similar story. Now, you had a little bit of a bull flag here. You could have taken it at 8.3. Again, you'll get your chances to buy these stocks probably cheaper at some time in the future. Not to say if you don't buy it today and close your eyes, you won't be okay, but I hate buying stocks extended at the high jump. Nucor. Yeah, I actually have a position here, and I bought right before earnings here. I think this was the earnings date, or this was the earnings date. I bought it by mistake. I didn't realize where earnings were. I bought it somewhere in this 3 or 4 day period of time. Sold off on earnings. My stop was below the 50. I ended up not getting stopped because I usually look at my stops at end of day. And basically, it exploded. Actually, take that back. I'm thinking Reliance Steel. I bought it here. I bought it right before the election, when it was coming off of a squeeze, mobile breakup from a squeeze, and the bongo turned green. I'm long Nucor and Reliance and U.S. Steel, so I'm mixing up my steel stocks. U.S. Steel I've been long for a long time. Nucor I went in at around 50, so this is back here. We'll look at Reliance Steel at some point. Pullback, this is what I love to see. Uptrend, pullback, what a squeeze. All the moving averages coming together. A Eureka, tell me the market's getting strong. Kahunas, that was a beautiful opportunity. Steel Dynamics, again, wouldn't you like to be buying here on this date? Kahunas, after pocket pivots, breaking above moving averages, bongo turning green. So the Reliance Steel, this is the one that I got burned. Let's find earnings on Reliance. So the earnings were, that's dividend. So I bought it here when it got above the 50-day moving average, and I looked at it, had a pocket pivot. I should have been careful because the bongo was red. It traded down. What I did is I had a synthetic, but I also buy a put underneath the synthetic to protect me. It traded down below the put, frankly, on earnings, below the protective put. So what I did is I just ignored it because I couldn't lose any more money on it. The call had very little value. and then all of a sudden it popped here, and I got saved by the rally. This is a typical pattern of what we're seeing now: run-ups, pull back into some type of a base, and then these stocks woke up with the Trump election and took off on the week after. This is the 9th. I thought maybe the election was the 8th, but taking off, wrong day. Yeah, taking up, going up after the election. All right, what else do we have? Base metals. Freeport-McMoRan, copper is a growth story again, I guess. This is the story. Uptrend, sideways, doing absolutely nothing, and then exploding after the election. The election was the 8th, and then gapped up on the 9th because of the expansion thoughts that are going to come on, and it's run from 13 up to 16.5, about 25-30%. Since the election, on a stock that, again, like the other metals, is starting to be a turnaround stock with some great earnings per share coming in, same as Techminco. So I look at these miners. Have they had a big run? They've had a big run. Would I be chasing them now? Alcoa, look what Alcoa did after the election. Another big move up. I'm not sure I'd be chasing them now, and I think they would have gone up no matter who won, because you had Hillary also was talking about stimulus, the one thing that we haven't seen much during the Obama administration. Now, regional banks, these have had huge runs, big benefits, if not only if there's some of the rules go away that limit what a bank can do, but also rising rates, Regions Financial, and these all, again, the same pattern. Here's a day after the election. Broke out, traded up, now going in a flag. PNC, HDFC, this is an Indian bank. Citizens, KeyCorp. I'm not smart enough to tell you which one to buy. What I did is I bought KRE, and KRE is an ETF for regional banks, and it looks just like the others. All right. A lot of strength in this market. Semiconductors. I mentioned earlier that this might be a place that you might see some opportunity. Micron's already in a big move. Had some good earnings. It's got great earnings coming in later. Big multiple. It's already had a nice run. Analog devices gapped up here. NVIDIA, been a big champion. But look at NVIDIA. I mean, was this not an opportunity to buy this after the election on the 10th? This is on the Thursday after the election. And then a big gap up. And you had many opportunities. You could have bought it off the 50 the whole way up. Here's another great buying opportunity. Nope, I wasn't that smart. On semiconductor, Qualcomm looks like one of those stocks that's going sideways. All it needs is a little momentum. We had some pocket pivots, and a Kahuna has some earnings coming in. I'll be watching. Qualcomm is one that looking for a breakout. And then Broadcom, again, going sideways. A bunch of Kahunas. Everything is green. Like that one as well. And all I do all weekend long is I go through the top groups one at a time. Oops. REITs. Now, with rising rates, these aren't supposed to do well, but look, here's a stock going sideways, moved up a little bit out of a squeeze on Friday. Everything is green. Pocket pivots and Kahunas, pays a 2.4% dividend and huge amount of earnings growing. So it pays 2.4%, which means it pays about 70, 20, 40, about 80 cents a year. It's going to make 93 cents in the next 2 quarters. Do I think there's an opportunity for them to start raising rates, raising dividends? Yeah. Hudson Pacific Properties. Public Storage, another 3.5% dividend. Buying it at a bottom. I'd like to see some energy come in before I would touch that one. Cyrus one that I've had in the past. Big earnings coming in. They own the colos where a lot of the technology is housed. Sold off hard. Again, would like to see more of an uptrend. So as I look at these, here's one pull back to the 200. I'd like to see a green bongo and a kahuna, pays a 3% dividend. But REITs, Iron Mountain did make my buy list. Why? Because it pays a 5.8% dividend, has great earnings. I'd like to see it get some more momentum. It did have a kahuna in the beginning earlier in the week. So they don't look great, but they don't look extended either, and they pay nice dividends. Biotech, boy, is this one a monster or what? Tesaro. This is what happens and why you own biotech. It's doing nothing, and then it has some breakout news, and it's been in a big run, and why you could have bought that Bible gap up here and made a lot of money. Currently at about 140. Tough to chase, but they have a great ovarian drug, and I would think they're highly likely to be taken out, although, you know, every CEO would tell you that's not what they want. Gilead, struggling. They'd be a good acquirer. They sit on a bunch of cash. They get major discount. They get paid a multiple of 6 because they don't have any growth. You can see their earnings going down. They have a great Hep C franchise and a HIV franchise, but not a lot of growth. Zyopharm, interesting pattern. Looked like it broke out here, pulled back to support, and then on Friday, it had everything was green, a kahuna. So I'm going to set a buy stop. Let's look at Zyopharm in person's work. Because I think this was an interesting stock. So what I'm looking at here is a daily, weekly, and monthly. So let's just look at, we are in a pullback with a new buy signal on the daily. We're breaking out on the weekly in a buy signal for a couple of weeks. And we have a new monthly buy signal. So that's good. So we're uptrend confirmed. I've got my on-balance volume is above the moving average on all 3 time frames. I like that. I can see my daily bongo just went green, and my weekly bongo's been in an uptrend for some time. I don't really care about the monthly bongo. I haven't flipped my PSAR dot yet, but I did have a MOBO breakout, and I did have a kahuna. So let's go back and make sure that I'm correct on that. There's my kahuna. There's my MOBO breakout. So when I see that, and so I see a stock in a weekly and daily buy, I'm going to want to buy this stock, but the problem with this stock is where I put my stop because this is such a long bar. So that's a negative, but I like this stock, and what I'm probably going to do is risk more than I like to risk, but I'm probably going to, let's open this one up now here. Look at putting a buy signal right above that PSAR dot. And that PSAR dot is at 759. So I might put a buy signal in at 760. And I'm going to put my stop probably at the low, at that 200-day moving average, which is 644. The low was 634. I'm going to put my sell stop or my stop at about 630, which is going to be right around here. So the problem is I'm giving it, it didn't come out right. Try that again. I have to remember to take my hand off this side. So the challenge here is from 760 to 630 is $1.30. So it's almost a 15% risk, which is more than I like, 17% risk, more than I like to take. But I might look at a small position on this. I got to keep my stop somewhere around that 200-day moving average, but I will quickly move it up once I get filled. So this is one that looks interesting, and the reason why it looks interesting to me is because group's strong, everything is green there, new kahuna, and if I can take out that PSAR dot, then every time you take out the PSAR dot, you typically get little runs. And I'd like to get a run here. And since biotech's a strong group, that looks like an interesting stock within biotech. BioMarin, I need some momentum to come in. AMAG, don't know what's going on here. It broke out on the 7th before the election and has had a nice little move up. Everything is green. Don't like the earnings per share growth. They're sitting on a pile of cash. They're one that I think will make an acquisition as well. Ariad Pharma, one that's always talked about as a takeout. Wouldn't touch this. It's at a double high. Breakout of that might be bullish. You know, I guess in a market where things were kind of flat and doing nothing, this is a good industry group, but it doesn't really look that exciting. Telecom carriers, another dividend story. You want to buy these after pullbacks and just make money on their dividends. So Verizon was better at 46, at $50, pays a 4.6% dividend. AT&T pays a 4.9% dividend. Sprint pays no dividend, and then here's a big dividend payer. Windstream pays a 7.8% dividend. They sold off en masse, I think, with concern about interest rates rising. I don't know if it's deregulation that's helping them or if folks realize that interest rates aren't going to rocket up. But, you know, these pay nice rates. Automobile index, interesting to see these up here. Tesla, it's all because I just bought one. I actually just bought a Model X P100D with ludicrous mode, but I won't get it for a couple more weeks. Downtrend, yeah, the last 3 to 5 days have been up. Had a kahuna 3 days ago, still in a weekly bongo, still in a downtrend. I'm not interested. I may be when it gets above that 50. GM, not so bad. GM is broken out. Everything is green. Don't love the earnings per share growth, pays a 4.4% dividend. Ford, still in a downtrend. So I don't like the automobiles. So isn't this interesting? The market's so strong, yet the groups don't look so good, except for the first 4 or 5. Consumer finance. These are others that did very well with the Trump story. Downtrend until middle of October and had the big breakout on the 9th after the election. 1.5% dividend. Synchrony Financial. Capital One Financial Group. Again, how many times are you going to have to see the same thing? Kahuna on the 9th. Breakout, pays a 1.9% dividend. American Express, not as obvious. But there you go, on your 9th, a pocket pivot, breakout, pays at 1.8% dividend. So this whole group acting about the same. So, you know, the sad thing for me is I've just gone through that, and I showed you some groups that look great, and then I'm trying to figure out where do you put your money, because these are all extended. And that's the problem. Maybe some of the semiconductors, maybe looking at some of the REITs or biotechs. But I really think for this market to go higher, you're going to need to see some participation, and especially participation in the canaries. So let's just look at the canaries, since a lot of us probably own some canaries. Here is Google. Doesn't look nearly as good as what we were just showing you. Everything is red up top, so very bearish on the technicals. Clearly in a downtrend, still above the 200-day moving average. Makes money. It's slowing down its growth rate. Yeah, there's Google. I'm not running out to buy it. Amazon looks better to me. I'm probably biased because I own it, and my puts are off, so God only knows what's going to happen to me on Monday. Big run up. This was the bottom. And that's an interesting thing, because let me just scrunch this up, because this has been kind of fun, interesting. This move started with a break above the 200-day moving average in early 2015. You came back and visited the 50 here in April and the 50 here in July. These were the times to have bought the stock. You had a big run from 425 or so up to 700 early this year, and then it rolled over after earnings in January. It had a huge decline down back into the 400s. Big roll up, got above 800, close to 850, and rolled over again. As much as you have to pinch your nose, this is a stock when it gets close to the 50, you want to start biting it. Earnings per share growth is good, still has a big multiple. Certainly the retailer of our time. Why do I like it more about Google? Because it's starting to move up. It's going to have to get up above the 50-day moving average. The technicals look weak. The earnings per share look pretty good. I like Amazon. I am long Amazon, and maybe it's hope over reality. Apple looks a lot like Amazon here, but it's kind of loosey-goosey here. Don't like the earnings per share growth, although they're starting to have some growth coming in. Maybe next year in anticipation of the iPhone 8, you'll start to see some movement in Apple. Facebook, Facebook, that's too much. Facebook has pulled down. Technicals are bad. OBV is down. Hard to love Facebook here, except, again, you're sitting right above the 200-day moving average. And over time, do you just want to buy Facebook when it gets down to the 200-day moving average, pinch your nose and hold on? I think the answer is yes. So on Facebook, I'm more of a buyer than a seller here. It does have good earnings per share growth. LinkedIn is a buyout. Netflix, is this a bear flag and then it's going to break down? I don't know. It's probably the healthiest of the bunch thus far. It's got great earnings per share growth, but a huge PE. It'd be interesting to see. A lot of narrow range bars. Don't know. Confused. Priceline, kind of the least bad looking of the bunch, maybe. Sold off here, but has been moving up steadily. It makes money. And Tesla we already looked at. So not a whole lot to love there either. So did I find anything that looked good? Let me just start with ranking my stocks that were buy potentials and just showing you the patterns that I saw, because I saw a similar pattern over and over again. So I started this weekend by looking at 656 stocks. And no, I don't want to look at 656 stocks with you right now. But here's the kind of things that I saw. In steel. Another steel company. That looks like it must be lighter traded. Yeah, too light traded for me. Big day on Friday, but it was only 300,000 shares. Broke out. Everything is green. Beautiful pattern. Not enough volume. I passed. Thor Industries. You got the Trump bump and moved up from 78 to 90. It's had a big run already. Winnebagos. Tarina, Educational Services. I guess this is still in a buy range if you like this. I don't like its lack of earnings. And I went through, and what I saw on so many stocks, and here's a beautiful pattern. Uptrend, pull back to the moving averages, in a squeeze, and we had a mobile breakout from a squeeze, a pocket pivot and a kahuna, and OBV turned up, and oh, by the way, it was the day before the election. So this was a stock to have bought after the election. Hudbay Minerals. Mineral stocks are supposed to be weak, aren't they? Monday, Tuesday, here's the elections. Moved from 5.5 to 7, 30% since the election. So I went through, and so many stocks pull back to maybe moving averages. Here's the day after the election. You could have made 25% on that stock. Grand Canyon Estates. Or Grand Canyon Education, I'm sorry. There it is, broke out. So you had cup, handle, breakouts, too far gone. So many of the good stocks. Now here's LG Homes. This one I thought was interesting. It makes money, twice its multiple. It's pulled back to support. I'd like to see, it broke above the 50 here. You can see the industry group. I'm looking for a little bit of help from my friends, a kahuna or a pocket pivot to get me in. But so many of the stocks that I saw, Domino's looked great, pull back, and then I guess the election was good for pizza because, pull back, and now it's moving up. HD Supply, horribly missed earnings. Pull back, and here we are, that's earnings day. That's Tuesday, the election, not earnings, but the election. And then Wednesday, breakout. Why? Because it supplies building materials. So this has been a funny market. I'm concerned that so many of the leaders are either gone too far, and therefore I either have to buy overextended stocks or I have to start looking at bottom fishing. So very quickly, just to go through some of the stocks that I did like for this weekend, and then I'm going to say goodbye. I'm at about an hour now. FedEx breaking out, getting extended, good earnings has got earnings per share growth, certainly a leader. Would have been nice to have bought it off the 50 back here. I'm looking for a pullback. I already showed you LG Homes. Apollo Management, here you go. Thursday the 10th, it broke out. So after the election, kahunas, pocket pivots, mobile breakout from a squeeze. Pays a 7% dividend, great earnings per share growth. Gigamon, I own some of this thanks to Gil Morales. Nice lower left, upper right, close to tight, leader in the market right now. Applied Materials, was looking at this prior to the election. It did pull back. It broke out here, and this is probably still in a buy range. Applied Materials. Here's a strong-looking semiconductor stock, probably too late to buy. Exelixis, a drug stock. I think this is a takeout candidate. So I look, and there are stocks that look great, but boy, they're extended. AEIS, Renewable Energy. Amphenol, another nice tight. Silicon Labs. Eagle Pharmaceuticals, this is one that pulled back. I'm interested in this one. I know the company, but this is very compelling right here. It's certainly not a beautiful chart. Let's just go look at it in TradeStation. And I could see a new daily buy. It's in a weekly buy. OBV is strong. Just had a big run already, but it's got some things that I like. So basically, there are stocks to like. It's a market that's extended. Here's a list of some of my favorite stocks, many of which we've already looked at. And on that note, I'm going to say goodbye. You all have a great week. Trade safe. Don't trade often. Trade safe. And don't overdo it. This market may take a breather, but I still think it gets higher by the end of the year. Goodbye, everybody.